So one of the overriding themes here at this conference, as you've heard, virtually everybody is unanimous in agreeing that the primary catalyst to the meltdown in 2008, as well as the ongoing problems that we're experiencing, is due to the government, its various entities. So one of the primary government entities, of course, that has been blamed is the Federal Reserve System. Now, the purpose of this debate this afternoon is to determine, is the Fed so broken that it should be totally abolished, or can it be modified or fine-tuned, whatever, and still continue? So on my left here, to vote for defending the Fed in some way, we have John Fund. First of all, John is an American political journalist and columnist for the Wall Street Journal. He's the senior editor and columnist for the American Spectator, and he's author of Stealing Elections: How Voter Fraud Threatens Our Democracy. And next to John is Warren Coates. Warren Coates is an advisor to a number of central banks. He retired from the International Monetary Fund in 2003. He led missions to over 20 different countries. He's a visiting economist for the Federal Reserve and the World Bank. He's currently director of the Cayman Islands Monetary Authority, and he's also been an advisor to the central banks of Iraq, as well as IMF consultant to the central banks of Afghanistan, Kenya, and Zimbabwe. Ooh, Zimbabwe. Obviously, they weren't listening to you, Warren.
They are now.
And then, for abolishing the Fed, our next panelist, Gene Epstein, is Barron's economic editor. He was also former chief economist for the New York Stock Exchange. He writes a regular column in Barron's, and he writes it from the perspective of the philosophical view of Austrian economics, the school of Ludwig von Mises. And finally, we have Tom Woods. Tom Woods is senior fellow at the Ludwig von Mises Institute. He holds a bachelor's degree in history from Harvard, as well as a PhD degree from Columbia University, and he's author of 9 different books. The primary book that is very appropriate to this discussion is Meltdown, a free market look at why the stock market collapsed, the economy tanked, and the government bailouts will make things worse. So I'll have each of our panelists start out with a 2 to 5 minute opening statement, and then we'll let the fireworks begin, and hopefully we'll come up with some practical suggestions on what we should do going forward, both governmentally in our economy, but also for us as investors. So Tom, why don't you lead it off? Can we get some liquidity up here in terms of water?
Yeah, good kind. Thank you. Thank you. And this will probably go right up to 5, and I promise I won't go beyond that. Okay. A lot of people seem to believe that although the market economy is a swell system, it requires the equivalent of a Soviet commissar to be in charge of money and interest rates. This belief is altogether misplaced. The Federal Reserve System, or simply the Fed, is both harmful and unnecessary. Since the Fed's creation in 1913, the dollar has lost at least 95% of its value. If the much maligned gold standard had produced such a result, we'd never hear the end of it. But in our system, the Fed is, for whatever reason, curiously exempt from criticism. Under the Fed, therefore, people have lost an option they once had, namely accumulating savings in cash. Under a commodity standard, people could save for the future simply by accumulating precious metal coins, which back when they functioned as money, held or even increased their value. No one has that option any longer. In other words, only a fool would try to save by piling up dollar bills. Instead, everyone is forced to become a speculator and to invest in securities markets they know little about and that can wipe them out entirely if times turn bad. As early as the 18th century, Richard Cantillon identified distribution effects as another way inflation harms the general public. The newly created money is injected at particular points. Whoever receives it first, in other words, people who happen to be politically well connected, get to spend it before prices have commensurately risen, and they thereby enjoy a windfall. By the time it trickles down to the general public, those people have been paying the higher prices to which the new money gives rise all that time. Private and public debt have exploded under this system, especially since the collapse of Bretton Woods in 1971. No one has a right to be surprised when indebtedness skyrockets under a system in which credit can be created out of thin air. The very existence of the Fed, a central bank, institutionalizes the problem of moral hazard. Moral hazard involves an actor's willingness to behave with an artificially elevated level of risk because he believes any losses he may incur will be borne by someone else. Since there is no physical limitation on paper money creation, market actors know the paper money producer can bail them out if things go terribly wrong. They have been vindicated in this belief time and again. They will therefore be more reckless in their investment activity and speculation than would otherwise be the case. We were once told that boom-bust business cycles were a thing of the past because thanks to the Fed we now had scientific management of the money supply. If anyone believes that today, I'd like to meet him. Artificially low interest rates, courtesy of the Fed, do not in fact yield us a utopia of sunshine and kittens. To the contrary, they artificially stimulate capital goods production and long-term investment. They thereby deform the structure of production into a configuration that the public's freely expressed pattern of saving and consumption will not be able to sustain. When this phony boom inevitably collapses, it is capitalism that is stupidly blamed, when in fact the Fed, a non-market institution, is the culprit. I am interested in neither the saccharine promises nor the technical details of the alleged superiority of a monopoly fiat money system. The Fed is the lifeblood of the empire, the great enabler of the perversion of the original American Republic into the world's largest and most powerful government. Even if the Fed did confer a net economic benefit, a contention the great Austrian economists F.A. Hayek and Ludwig von Mises strenuously denied. In fact, Hayek won the Nobel Prize in the process of denying it. Even if the Fed did confer a net economic benefit, the alleged benefit could not possibly be worth the destruction of the American soul. As it turns out, we don't have to make that choice. When it comes to the Fed, justice, economic prosperity, and the values of the original American Republic are joined together. The Fed, its academic apologists, and the drones in our supposedly free press who demonize all dissent from the monetary status quo have done our economy enough damage. For the sake of American freedom and prosperity, it is long past time that, in the spirit of Andrew Jackson, we killed the monster. Thank you.
All right, John, you want to go next?
No, it's Warren.
You want to go next, Warren? Okay, Warren.
Thank you very much. It's a pleasure to be here again. I want to note that my first trip to Zimbabwe was just a month ago after the collapse of their currency, and our strongest advice to them, they've dollarized and are literally using the U.S. dollar, was to continue that regime and not to reintroduce their own currency anytime soon. So I would have to defend the Fed today, having endorsed Zimbabwe's embrace of the U.S. dollar. Our topic is fed up with the Fed, should we abolish? This is not a topic about whether the Fed should adopt a different policy regime, such as a gold standard, but whether we should have a central bank at all. I can't resist noting Gene and I debated the topic of the gold standard last year, at which time the price of gold was $970 per ounce. This morning it was $912. I just thought you would like that market update. So the first half of the topic, Fed Up with the Fed, calls for a review of Fed policy. Has it been good? Has it been bad? What's the scorecard? And I don't want to go back through the entire history of the central banks. Central banks generally don't have a very good history and track record, and the Fed certainly has its black marks over its history as well. But let's look at where the world has come in the last several decades, because a lot has been learned, and monetary policy has been dramatically better around the world, including here in the United States. So let's start with Paul Volcker's Fed that killed the inflation of the late 1970s, when the inflation rate in the U.S. got up to 14% or so. Since that time, it's averaged about, or since 2 years after that, as he brought the money supply back under control, inflation has averaged about 3% per annum for that several decade period. Real GDP has averaged about 3.2%, which is its average for the last several hundred years in the United States, up through the first quarter of this year. And over the this decade through 2006, leaving out the recession that we are now in, it averaged 3% per annum. Over this period, we had about half the number of recessions, this last 30-year period. We've had about half the number of recessions that we did throughout our previous history. The Fed's record in these last several decades is not all roses, however, as you know. The Fed did keep interest rates too low for too long between 2002 through 2004, contributing to the housing price bubble. This is true. But low interest rates had other market forces contributing to the low interest rates as well. An overvalued U.S. dollar produced large and growing trade deficits that sucked dollars in from China and other countries, keeping interest rates low. With a gold standard, interest rates would have been even lower until the trade deficit was reduced, as all adjustments would had to have been made through domestic prices. Markets are the best way of reconciling conflicting forces and moving the economy forward, but because it's the best system doesn't mean it's without its challenges and difficulties and hardships. How has the Fed performed in the last 2 years? The Fed responded to the financial crisis emanating from the collapse of the real estate bubble in several ways. First, on the monetary policy front, it reduced interest rates in the face of a collapse of aggregate demand to soften the impact of the fall in housing and other asset prices, and prevented a collapse in the money supply after September 2008, September of this last year, by doubling base money. These traditional central bank functions helped restore confidence in the financial sector and moderate the inevitable recession as the economy deleverages and adjusts to new realities. In this area, the Fed has performed very well, not repeating the mistakes that it made during the Great Depression that contributed to the Great Depression being what it was. On the credit policy front, the flow of credit froze up as financial markets began to realize the extent of potential real estate losses and started to deleverage. The Fed introduced new facilities to help specific credit markets, buying mortgage-backed securities and commercial paper, to name two. This is not a traditional central bank function. The Fed should have had greater faith in the market's ability to develop new credit channels and to redirect credit to the most productive uses. In this area, Fed performance was helpful in the short run, but harmful in the long run. It was inappropriate, and the Fed should unwind these activities as soon as possible. On the failing institution resolution front, The Fed joined the Treasury in ill-advised, damaging, and for the Fed inappropriate and possibly illegal market interventions to save investment banks and an insurance company. This was motivated by the lack of legal tools with which to resolve failing non-banks in the ways banks may be resolved, but it was an end run around the law at a time of panic. It is also hard not to wonder whether personal Treasury relationships and past and potentially future employment on Wall Street clouded the judgment of Treasury and, to a lesser extent, Fed officials. One way or the other, the rules of the game have been changed and are now unclear. The long-run damage will be difficult to repair. So should we get rid of the Fed? The answer, I'll provide mine and you can then come back with yours. The answer depends on whether we believe not having a central bank would be better. In time, alternative arrangements could be developed to clear and settle payments across different banks or different institutions of payment, and to print and coordinate the value in the market of private currencies.
Can you wrap it up?
Yeah, okay. The benefit would be the benefit of a purely private monetary system would be clear rules with very strong market discipline and private behavior. These are important benefits. The costs would be periodic financial panics and crises that would very likely overturn the system with massive government intervention. Let's not throw out the workable for an imaginary utopian best solution, and I will leave that to my partner to elaborate.
All right, Gene, you want to give your point of view from the abolish the Fed standpoint?
Well, it's fun to be appearing in opposition to John Fund. We both work for Rupert Murdoch. He acquired Barron's and he acquired the Wall Street Journal. Indicates to you that maybe Murdoch's world is a mansion of many rooms, although the killer anecdote I like to hand people is that Murdoch's publishing arm also puts out Howard Zinn's left-wing People's History of the United States. The man puts profits before politics, and indeed, the fundamental reason why I am pro-capitalist is because free speech, freedom of the press is something I hold dear, and private ownership of the means of production is a necessary condition to the maintenance of free press and free speech. Similarly, the abolition of the Federal Reserve is necessary in order to bring back government accountability to the people. It's fairly simple what has happened over the last few centuries, even before the Federal Reserve was created. The kings wanted to fight their wars. They couldn't borrow enough. They couldn't tax enough, so they started to print money. That's why the government began to control and get interested in controlling the money supply. In the more recent period, under Bismarck, under FDR, it became apparent that the welfare warfare state cannot be answerable to the people. It's got to depend on the mechanism of printing money, and the Federal Reserve is central to that. The only way to get back to our republic, the only way for the government to be answerable to the people, not to propose programs before it knows how to fund those programs, is that we abolish any means by which the government can control the money supply. Now, notice I haven't said anything about economics yet. I'm talking about fundamental political values that are vital to the maintenance of freedom. That's the fundamental reason why we have to abolish the Federal Reserve, and indeed, not just abolish the Federal Reserve, but understand that any government control of the money supply, because control of the money supply by the government has been ubiquitous for centuries. It was very, very apparent in the 19th century, before the Federal Reserve was created. That's also why we had monetary instability and corruption, or indeed the War of 1812 was financed through the printing of money by the New England banks, and then the protection of those New England banks by the government. All of that sorry history, it depends on government control of the money supply. Now, Why else would I abolish the Federal Reserve? Because it causes business cycles. Warren just spoke, Warren Coates, on the opposition, just spoke about what the Fed did and didn't do right after the collapse of the economy over the last couple of years. Well, let me give you a little anecdote that does not even require an understanding of Austrian business cycle theory. The driving force of the real estate bubble was something known as adjustable rate mortgages, ARMs. They were disproportionately where the mortgages were coming from, where the bad debt was being created. Now, adjustable rate mortgages are directly tied to the one-year rate, and the one-year rate is directly dependent on the federal funds interest rate set by the Federal Reserve. The Federal Reserve was directly, in that sense, financing the housing bubble. And indeed, on top of everything else, the crowning irony is that Alan Greenspan himself got up in front of a bunch of realtors and said, ARMs are wonderful. Adjustable rate mortgages are a great deal. You ought to sell them more aggressively to your customers. That's one simple anecdote that I suggest Warren Coates embrace, understand, in order to appreciate the fact that the Federal Reserve was part of the problem. It created the bubble. And then afterwards, it's the drug pusher, and afterwards it gets to run the methadone clinic and claim that it didn't push the drugs in the first place. So simply put, in order to have political freedom, in order to have economic stability, we need not just to abolish the Federal Reserve, we need to declare that money and interest rates are the province of the free market. When Congressman Ron Paul asked Ben Bernanke, do you ever get the interest rate wrong? Ben Bernanke said, yeah, we do occasionally get it wrong. We try, but we get it wrong. And Ron Paul said to Bernanke, well then, why not occasionally, why not eternally leave the interest rate setting to the market? Because you get it wrong, maybe the market will get it right a little bit more often than you do. Is my time up? Do I have any more time? Okay. Where's our moderator? Oh, I'm through. Okay.
All right. And now, lastly, we'll have John Fund give his view from a pro-Fed standpoint, and then I'll get the ball rolling on the debate with a question to all of you. So, John?
I'm not going to wear the pro-Fed hat. To paraphrase Shakespeare's Mark Antony, I come neither to parry the Fed nor to praise it. I come to be realistic, and what we have is clearly a deeply flawed institution. But I would remind you that while certainly I think the Fed can be said to have exacerbated some of the business cycles and perhaps prolonged the period by which we flush out malinvestment, there were panics and there was market instability that led to the creation of the Fed. The famous panic of 1907 being an example, the one that J.P. Morgan had to step in and ameliorate at the last minute. The Fed exists for a reason, providing short-term financing during periods of financial panic. I would remind you the 30-day commercial paper market dried up completely last fall. There was a panic. There was a sense, not just in the government, but among the business community, that something had to be done to inject liquidity into the market promptly. The uncertainty the Fed causes is a real cost. On the other hand, my worthy opponents have spent 10 minutes bashing the Fed without giving you any sense that there's an agreement on their side as to what should replace it. And of course, yes, the market, they say, should replace it. But exactly what structure, what mechanisms, how do we get from there to here? And I'll return to that theme. The Fed has taken on far more than a central bank even should take on. It has taken on responsibilities regarding full employment, protecting depositors through an insurance system, many other things. As Richard Rahn points out, the Fed has taken on so many responsibilities it's become like a large fire department that has a fixed percentage of its employees who are arsonists. So as it gets bigger, there are always more fires. Well, I propose there is another course. We have a Fed that is targeted, simplified, streamed down, and focused on its mission, which is preserving the integrity of our monetary value. New Zealand had the same problems in many respects in the 1980s. They had a financial meltdown. They didn't become a banana republic, they became a Kiwi republic because even Kiwis were in short supply in New Zealand. What did they do in response? They created a completely independent, hermetically sealed off central bank. They appointed a board of governors that were tasked with one job only, and that was to keep the rate of inflation within certain targets. And the head of the central bank was rewarded financially if he met those targets, and he was penalized if he failed to meet those targets. A simple mission, a simple set of clear rules, and a simple set of incentives to put those in place. And New Zealand has prospered ever since. Now, I'm not saying this is easy, but neither is slaying the monster without an idea of what you're going to replace it with. Now, Ronald Reagan, who was a follower of the Austrian School of Economics, had some interesting debates when he was in the White House with his private advisors about the Fed. And he always would end these discussions with, well, show me how to get from here to there and we can talk about it. Until then, I think we should recognize that while the Fed creates uncertainty, having a debate about abolishing the Fed without having a clear idea of what's going to replace it creates further uncertainty. And I would submit to you, at least from the point of view of the business community and from entrepreneurs, during that period of time of turbulence in which we debate the role of the Fed without a clear idea of where we're going, we're not going to have economic growth. We're going to have perhaps more instability. So, I submit to my worthy opponents, I share some of your critique, I share perhaps some of your values, but I also understand that we live in a practical world. In conclusion, I always liked the unicorn when I was growing up. The unicorn is a wonderful creature to behold. I'm pro-unicorn, but I've yet to find one. And I don't believe in spending all of my time searching for the unicorn, thinking that I will find it, because so far I haven't. The same thing with a world in which we have abolished the Fed without a clear idea of what to replace it is a search for the unicorn, which we have yet to find on this earth. Thank you.